Just want to say good morning to everybody. Welcome to the fourth session of the CDI Masterclass series, Creating Your Roadmap to Recovery. Thanks for joining us. I'd like to thank our sponsors, the City of Cape Town, Invest Cape Town, and UNESCO for making the series possible. I'm going to hand over to Peter and Simon to introduce themselves and their business. Over to you guys.
Thanks a lot, Ryan. So as Ryan said, we're going to be talking through understanding and managing your costs, which is part one of the two-part series that we're going to be talking around the second one on Wednesday. Myself and Simon, who are we? Well, we're the two directors from Iridium Business Solutions. It's a 7-year-old cloud accounting business, and we're essentially brothers. Simon's a little bit older than me, and he's also the founder. I came slightly afterwards in the first 9 months to join him after I finished my articles. We're both chartered accountants. As I said, we're both brothers, and we're both passionate about technology and how you can use technology to kind of streamline your business and business processes. We both really strongly believe that small business and SMEs are the way to drive the South African economy forward. And as a result of that, decided that when we're looking at helping businesses, we realized that there was a big gap between your knowledge of a small business owner and the actual requirements to properly run a business and to take it forward and to grow it. The also cost to go to those bigger accounting firms was just untenable. So we come in at a much more reasonable cost, but also provide a really good quality service. We've built it up to a team of 23 currently, and we work mainly with people who are straight out of university, and we teach them how to kind of assist from a financial management perspective. We work and train them up in two different disciplines, one called CIMA and another called CIPA. They're both management accounting, professional accounting qualifications. Simon's an MD, and I stay on Facebook, LinkedIn, and all those a little bit too long, so I'm the sales and marketing director. And as I said, yeah, we're just really passionate about small business and helping business owners. So today, that's kind of what we're meant to be doing. And we're going to be looking into a few areas, especially around understanding your costs and managing your business. To start off, we're just going to run through a couple of key rules for today's webinar, ask you what you'd like to get out of it today, and then walk through a couple of types of business entities very quickly, why understanding your numbers is really important, some statutory costs and benefits that the government's put in place, some scenario planning with your limited cash, which is something that everyone right now has. Look at some types of business costs and reviewing your cost base. I'm gonna move on. Simon is just going to chat around some types of business entities. So kick it off, Simon.
Thanks, Peter. So then if we just look to the three types that exist. So a sole proprietorship you set up effectively by deciding you want to run a business. To start a sole prop is as simple as just going into the bank and opening up a bank account and saying, I want to call the bank account this name. And the sole prop is you acting as a business. So you might be calling it a name, but effectively there's no legal structure to it other than yourself. And that is how you start a sole prop. And all the taxes relating to it from an income tax point of view relate to you. Whereas a private company or PDY Limited, that is something that gets set up with directors and shareholders, and you go through the CIPC to set that up. And a closed corporation, like I mentioned earlier, is something that is also a legal structure. It's just they are no longer like a PDY directors and shareholders, they are members. So you'll be a member of a CC, not a director or a shareholder of a CC. And like I said, CCs no longer exist from a new setup point of view. So all CCs in existence were set up previously before they changed the rules and said no more CCs are allowed. And I think the rules were changed in the late 2000s when the New Companies Act came into existence. One of the key things we just wanted to point out here is that companies operate on the basis of limited liability. And what that means is, as a general rule, shareholders or members are not liable for the debts of the company, but sometimes there are exceptions. And one of the key things we want to point out here that we've seen is with a lot of the COVID loan funding that came out, that's been offered through the banks, even though these loans are backed by the government, most of the banks we've interacted with have said they want personal surety signed. And what personal surety means is if the business were unable to pay the debts of that loan, the bank can come after the director or the shareholder who signed that personal surety. So in other words, you're not having that separation that a company would normally provide you of the limited liability, that you're going to be personally liable for that. So just interesting just to note that, whenever you're signing something, be careful that if you're signing personal surety, just know that if something goes wrong in the company, you can be held liable in your personal capacity, which is one of the main reasons why we set up companies, to have that separation of self and business in case something goes wrong. So I think that's kind of the key thing. And obviously also in companies, if a director acts negligently, they can be held personally liable, because the implication of a director is that you can act responsibly and do things that you should. So I think that kind of covers the types of business entities. I think that's kind of all we wanted to cover there. Okay, now this is really, really important, and not just because I'm an accountant and I deal with numbers every day of my life, but because we really think it is something that a lot of people don't understand completely. And this is irrespective of if you're running a 100 million rand company or 1 million rand company. So numbers are super important. A lot of people are scared of what numbers mean, but we really think it's important to take responsibility of knowing what your numbers mean. And when numbers get allocated in your accounting records, where have they been allocated and what do they mean? And we've had many instances where someone's come to us and said, my salaries bill per month is 400,000 Rand. And when you go and look at that expense account, you realize someone's incorrectly allocated things to that. And that actually means the number you're looking at is wrong. So it's very important to know that numbers are allocated correctly so that you can actually understand what you're looking at. Reviewing monthly your numbers is super important. So we really want people to look at their accounting records on a monthly basis and understand what numbers they're looking at. It doesn't just help to look at your bank balance. You need to be looking at a profit and loss or income statement on a monthly basis and understand what you're looking at. And when something is different from what your expectation is, you need to be able to know why is it different and what caused it to be different from what I thought it would be. There are really great benefits of reporting and actually digging into your information. So do you know who your top customers are? If I asked you who the top 5 customers you deal with right now are, why are they your top 5 customers? What are the top products that you sell right now? What is the GP percentage per product that you make? Because that should be really dictating how much time and effort you spend on marketing certain products that are out there. You don't want to be marketing something that's a really, really low-end GP product, where you should be pushing another product which makes you a much higher margin. So all those kind of things are going to help you know where should you be pushing revenue and what your focus from a product point of view should be. And all of this is talking to having good underlying information. So if you don't have good underlying information, how are you going to know what's going on? One of the clients that I work with runs a bakery, and it's a small artisanal bakery. And I said to him, do you know who your top 5 or 6 customers are? And he said, I think I know who they are. And he rattled off a few names. And when we went and looked at his data for the last 6 months, we actually found out that 2 or 3 of those names were in there, but there were other ones that he didn't even realize they were actually significant customers. And I said to him, you can actually see your top 6 customers are making up 60 or 70% of your turnover per month. And what that really means is you need another few customers that fit into that same kind of size customer that's going to allow you to grow. So he didn't actually need to go out there and get 30 new customers. He just needed another 1 or 2 that fitted into the same category in terms of daily turnover or monthly turnover that would have shifted his business forward. So that was really helpful. The profit triangle. So the kind of analogy that you increase volume, decrease expenses, or increase GP, and you're going to be in a better position. So I think it's really helpful to kind of understand that that kind of analogy of, or that kind of comparison of saying, I can increase my volume, I can decrease the expenses that I'm incurring right now, or I can increase my GP, and they're all going to result in a better bottom line. You can be playing around with various variables there. If you get a better cost from your supplier, that's going to mean your GP is going up on that product, assuming the same selling price. If you can push up your selling price with all your costs being held the same, you're building a bigger gap there, which is going to result in a better GP. So it's really, really important to understand those costs and what makes it up. And I think anyone in the business of selling a product needs to know exactly what all the costs relating to making that product are. And you definitely should always be looking at them and playing around with what those costs mean. I had another client of mine that was in the sauce industry. So they were making sauces for retailers and production kitchens. And he said to me, if he added another 5% water to the product, it was exactly the same taste, and the client was just as happy with it, but it dropped his cost by 5 to 10%. That was a great kind of thing for him to actually look at and go, I'm getting the same result, but my cost has gone down 5 to 10%. I've now increased, my bottom line without changing my price, without changing any internal costs of my business. And those are the kind of things that are really, really important to know. Another thing that we find is super important is to understand the role of your accountant. What is the job of your accountant in your business, and why do you have them? They are not there just to keep you statutory compliant, to make sure SARS doesn't knock on your back door. And we often find a lot of people are scared of SARS because they're worried that SARS is going to take something away from you or make your life difficult. That shouldn't be your focus of your accountant. Your accountant should actually be there to say, can I help you, give you good information on your business? And if there's something you don't understand, let's talk about it and let me help you understand it in a much better way. And the other thing to understand is, what is your accountant's responsibility and role, and what is your role and responsibility? And I think sometimes that when it comes to financial matters, business owners go, it's not my responsibility, it's my accountant's job. And I think that's really important for you as a business owner to know what's important for you and what's not important for you to be responsible for. And I think the key thing from my perspective is, your accountant is there to provide expertise. You are the person owning and running the business. So if there's something that you are unclear about or not sure about, you always want to be making sure that you get the expertise from your accountant to help run the business. But ultimately, you are the one running the business, you and your other directors and shareholders. So you need to make sure that at all times, you know what's going on, and never just assume the accountant has done or hasn't done something. And then I think there's three kind of key roles here. I've been using the word accountant, but effectively there is a bookkeeper, an accountant, and an advisor. Those are three different kinds of functions that are performed. And I think often people make the assumption that one is the other. So a bookkeeper is typically someone who takes your bank statements, your supplier invoices, and customer invoices and processes those in an accounting system or in a Excel spreadsheet, and they put that data together. And that's typically where most of their jobs would end. They might do the payroll, they might help do a VAT return, but that's kind of where they end in their responsibility. Often the accountant is the person who would interpret that data, sometimes talk to the business owner and explain one or two things. And in other cases, it might be the person who works with the bookkeeper and now takes it from a trial balance and prepares financial statements and income tax returns. But often what happens is the accountant only gets involved on a once every 6 months or once every 12-month basis. So it's not a regular intervention, whereas often bookkeepers are involved more regularly. And the accountants don't always tell the business owners what to do or how to do things. They're much more reactive. So when someone asks them for help, they come along and provide their assistance. And then advisors are people who normally understand your business and talk to your business and really go through what's happening in your business. So I think those are kind of some of the key things there. Often what we find is that people are doing internal invoicing, and that's done on a piece of paper, on a Word document, an Excel document, a PDF, and that is sent out to the customer, and the customer pays into the bank. But everything else from an accounting point of view is not done internally by the company. So that's one of the trends we've noticed a lot of people have. And that means they don't really have good insights to what's going on a regular basis. And the management of debtors is done relatively manually. And all the expenses, there's no real sight of it until the accountant provides a report from their own system. So I think that's one of the key things we just wanted to kind of get across here. And I think one kind of last point that I just wanted to make around businesses and kind of management is that the main reason why we see a lot of small businesses failing or struggling is on cash flow. Not on the fact that they have a good product or a bad product, but on the fact that they are struggling with the cash flow coming into their bank account, that they can't pay people when they need to pay them, and that they're not able to control that process of cash coming in and out of their bank. And I think all of that talks to having really good information. So there definitely are a few areas there where people can improve on, and having better understanding and insights to your information will definitely come from having a good accounting system and knowing what those numbers mean. So it's definitely something to consider. And it's just, I mean, just to point out, you know, if you decide to have a chat with us after these sessions, you know, that's one of the things that many people discuss with us is saying, how do I manage my cash flow better? What are some tips to manage my cash flow? And what are the right decisions to make in running my business to ensure that I hold on to cash to settle things when I need to? So I think that's something we're going to actually look into a little bit later, but just a thought to consider as we're going through. I'm going to hand off to Peter, and he's going to discuss a couple of topics here.
Hey guys, back again. So I know this stuff is not necessarily the most exciting topic, especially when you're talking about SARS, Department of Labor, and CIPC. I suppose over the last couple of months, it's become a little bit more exciting because the government has given a bit of relief to business owners in these areas. And so this section, we're going to just chat a little bit about the various topics. And I know most of you understand what these are, so I'm not going to necessarily delve into the input and output of that. I'm mainly going to focus on, you know, the fundamentals of this is VAT, and here's some relief measures that have been put in place. So VAT, essentially, if you don't know, it's mandatory to be registered for VAT just over $1 million in turnover, and that's in a 12-month cycle. I know they recently slightly adjusted that number. I can't for the life of me tell you exactly what it is right now, but I think it's 1.2 or so million right now. And that's a 12-month cycle. So it's not in your 12 months of operating your business from a financial year. It's actually any 12-month period that if you go over the million, that you are required to register for VAT. A weird thing, but I know a lot of people are scared about registering for VAT because they feel like they're going to lose money as a result of that. I'll talk a little bit about that slightly later. But the other one that catches people, I know most of you don't necessarily fit into this gap, but it's you shift to a monthly cycle after 30 million in turnover. Now, the concept of VAT is that we're actually just agents on behalf of the government who collect VAT. So we're taking whatever our pricing is and adding VAT on top of that, which is why I say I think a lot of people get confused. They start off with the price of their goods, let's say 10 Rand when they start the company, and then they feel hard done by because they either have to increase it to 11 Rand 50 or suck up the consequences of VAT and keep it at 10, and they suddenly lose their margin. And I think the odd thing that I often find is, well, that pricing mechanism is not around taking a price and adding VAT. It's actually what your customers are willing to pay. So we always tell when somebody's starting out a business to actually price, assuming that you will have to be registered for VAT at a point in time, price that number. And when you are registered, well, you've just benefited for the last year or two from the fact that you've had an extra margin. We never recommend actually adding that to the existing number, because your customer doesn't understand the fact that you're not registered versus registered if you're dealing with end consumers, not necessarily business owners. If you're in a business-to-business relationship, it's less of an issue because your business owners are able to claim the VAT anyway. So it's not really a change in costs to them. It's just a change in cash flow to them. Now, I think the big couple of wins in terms of VAT that I've seen is mainly around, well, it's actually just one win around the ability to claim your refunds on a monthly basis. And that started as of May. So effective from May, for the next 4 months, you're able to claim on a monthly basis your refunds. And because we're not selling as much and we're still incurring costs, more people will be in a refund position. Things to note, if you're a category A or B, what that essentially means is an uneven period of VAT or an even period of VAT. You still benefit from that 4-month cycle, and it just depends. If you're in an uneven period, you're going to file your return in June. The even period, you're going to file your first return in essentially July. The big thing around this, though, and with a lot of the relief currently out there, is the fact that you need to be tax compliant. And we've seen a lot of business owners struggling in this regard. And I think it talks to the previous slide that they haven't had their financial statements filed on time, or they didn't realize, but their accountant filed something late, or they have filed something late and have incurred a penalty and are not compliant. So I think it's really important to delve into understanding whether or not you're tax compliant, going on to SARS e-filing or asking your accountant to pull a tax clearance check for your business, because all of these benefits from a SARS perspective require you to be tax compliant. The other thing around this is there's no requirement to register. You actually just are able to submit. In terms of PAYE, and STL and UIF, once again, that's a monthly cycle on the 7th of every month. Most of you who are registered for PAYE should know this. And SARS collects the funds for STL and UIF on behalf of your various CETA, which is your training institute, or the Department of Labor. What's important to understand is, once again, SARS is just an agent for these places, which means they're not filing your Department of Labor UIF returns. I think a lot of guys also got caught up during this period of time when they wanted to claim TERS and submit for UIF their various employees. And we've seen that if you don't have good systems in place, processes like filing your UIF return on a monthly basis by the 7th of the month, along with your payroll return, fall by the wayside. And it's one of those topics, if you aren't talking to your accountant and saying, do you file my UIF return or not? You'll probably find if you don't have that kind of conversation with them, it's not happening. Over the last 7 years, Simon and I have seen a lot of business owners just not know that they had to file a UI-19 through the Department of Labor on a monthly basis. And as a result, they were either not registered with the Department of Labor or just were non-compliant since the start of their business. And finally, SDL, most small businesses don't necessarily fit into this, but if you are in the space where you have salaries above 500,000 Rand for a year, you're required to register for SDL, or Skills Development Levy, which is a levy to help your employees actually upskill themselves. And you're able to claim from that levy through your CETA. So it's important to check out whether or not you qualify and if you can claim. In terms of the relief, there's been a 35% deferral of PAYE. It's not a holiday that you don't have to pay at all. It's just deferring to later. And I think it's important to understand that, because you do need to pay that at a later stage. And when you're planning your cash flow, you need to plan that you're slotting that cost in at a later stage, which is, for this case, it's in September. And it's going to be a 6-month period that they're slotting that 4-month relief over. It's from the 1st of April for the next 4 months. And the other benefit that was kicked out was the skills amendment levy from May, being this month, for the next 4 months as well. Once again, you need to be fully tax compliant. And we've got a little guide that SARS have put together just to help you understand the process for this. It is quite simple. You essentially submit your return as per normal. And with STL, you just exclude STL. And when you're making payments, you just make sure you pay short on that by the 35% for PAYE, not for the UIF portion, for the PAYE portion only. As I said, it's not super exciting, but what we have realized is these savings have been fundamentally life-saving for our clients over this last 2-month period. And it's also been quite important for our own business. We've been taking advantage of the PAYE, the STL, TERS, and many of the other benefits to help prop up our cash flow over the next few months. In terms of ETI, it's an incentive to essentially employ youth under a certain age bracket. So it's the 18 to 29 bracket, and it's to try and get them into jobs quicker and give them some money, because we have a really high unemployment rate in South Africa. So it's one of those mechanisms that the government wanted to put in place to try and incentivize business owners to employ the youth. And the main benefit is that it reduces your PAYE on a monthly basis. But essentially, it is what it is. It's if you're below 6,500 Rand a month in salary and you fit in 18 to 29, there are a couple of other criteria, but for the most part, it's kind of those. You as an employer are able to benefit from a sliding scale of an incentive. So if you have somebody that's earning 2,000 Rand a month and they're working full-time for the month, you can actually have 1,000 Rand off your PAYE bill for that one person. And if it goes up to about 4,000 Rand, it drops down to about a 500 Rand benefit. So if you've actually got a large kind of employee base, you're able to actually save quite a significant amount of PAYE during that as a result of ETI. And I know in the manufacturing space, there's a large number of people that are employed at that lower range. Even in the retail space, I've seen a lot of people at a much lower rate. And similarly, the hospitality type industry. So it's one that you really want to take advantage of. The main benefits here are that the government said you get an additional 750 Rand on top of the whatever other benefit that you've already claimed per person. And they've extended the criterion to be 30 to 65 as well. So it's essentially 18 to 65 range. If they're below 6,500 Rand, you get to claim. But also, they've said you're able to claim 750 Rand from a 18 to 65 period, as well as they originally had a 24-month period where if you had been employed for 24 months, you no longer were part of the ETI incentive. Now they're saying you're able to claim an additional 750 Rand for each of those employees. On top of that, historically, they've said that they don't pay out in cash. They rather let this amount roll over. Now they're actually paying out excess above your PAYE in cash 10 days after you've submitted your EMP Tier 1. if you're fully compliant. Now that if you're fully compliant comes in, as I said, to a number of these slides. If you're not fully compliant, they pay out, I think, 6 months later when you're submitting your EMP 501. But essentially, this is a massive win. If you're using already, awesome. But that's 6% of the entire conversation that we're having are currently using it. So I think if you actually fit into that area of employing people below 6,500 Rand, you need to chat to your accountant, your bookkeeper, chat to us. The last one, I think from a SARS perspective, is around the provisional tax. And now it's not necessarily a benefit right now, but like Simon said, cash flow is one of the biggest reasons why people and businesses fail. So it's not just how much cash do I have for this month. It's actually how much cash do I have for the next 6 months, and planning ahead to make sure that in 6 months' time, your business will survive. And it's a scary thing to look at, because sometimes you plan ahead and go, my business won't survive after month 2, or I can't move forward after month 1. But it's important to still keep extending it and saying, look, how far ahead can I go, and let's see how bad it gets. Because then you're able to use the mechanisms and the loans out there and these other mechanisms to try and supplement that. And people in general, when you're asking for cash flow relief, they want to see 6 months at least ahead. So in terms of provisional tax, if you don't already know what it is, essentially it's a mechanism to pay your taxes for a company and also for an individual, but we're focusing mainly on a company every 6 months. So if you were an individual, you typically pay PAYE on a monthly basis through your salary. Now, businesses don't have that monthly mechanism, so the government brought in an every 6th month mechanism, which is where provisional tax just literally says how much profit did I make for the first 6 months or second 6 months, and therefore how much tax should I be paying. And so it's every 6 months of the financial year you're paying that. And then the third provisional payment is 7 months after year end, if your year end is February, which is what most businesses year end is. So that's September, or 6 months if you're not a February year end. And as I said, the first two, those are to pay for your financial year. If you short pay the government for those, when you add up those two, they actually fine you and charge interest on that money that you effectively short paid them. The only way to cancel out part of that, being the interest portion, is by paying provisional tax 3. So you don't incur the interest, but you still incur a 10% penalty on the short pay to the government. Now, it's all these little penalties along the way, paying your PAYE late, your VAT late, your provisional tax late, end up adding up quite a lot. And we've seen a number of businesses actually have to close their businesses down because they weren't paying their taxes on time. And it's a silly decision to make. If you can't pay it, well, then you need to look at what the best options are. Should you borrow from the bank to pay it on time? The bank's interest is going to be cheaper than SARS's 10% penalty. So you need to weigh up those decisions and make sure you're making the best possible decision each time you're paying out. And your corporate income tax, well, you don't necessarily pay corporate income tax. It's paid through provisional tax, but you have to be filing your corporate income tax return 12 months after year end, along with financial statements. And if you don't do that, you fall in that non-compliant category and you lose out on a lot of these benefits. You are able to remedy it and then start benefiting, but you don't get the benefits that you've lost out. So it's really important to look at what your financial situation is, what your tax situation is, and try and weigh that up and make the best possible call, saying, if I remedied all my tax compliance, what additional benefits would my business be able to take advantage of? So in terms of provisional tax, what they've said is your first payment, which is 6 months after the start of the financial year, which for most of you is probably going to be sitting around August. You, instead of paying 50% of your total prov tax for the year, you actually only have to pay 15%. So it's quite a significant drop. And your second payment, you pay 65%, which is 50 plus the original 15 you've already paid. And then you're able to essentially utilize the Prov Tax 3 to pay the remaining 35%. So they are being quite generous in the approach around provisional tax to try and give you relief. And you guys, most of you might not be thinking about it right now, but it's something that you need to think about when you're looking at your cash flow projections and your forecasting of your business. Once again, there's a SARS guide that kind of talks through the different options, and I'd highly recommend taking a look at that. And finally, penalties and interest. What I kind of spoke about previously, most business owners right now, cash flow, as I said, is the big challenge. And we've seen a number of clients say they can't pay PAYE or they can't pay VAT. It's just too much because they might have earned a lot of money and paid a lot of or benefited a lot during January and February, but come March, April, they are now in a cash flow squeeze. And so what the government has said essentially is, we understand that, and we don't want to penalize you for the fact that you're in a tight position now as a result of COVID-19. So you are able to actually apply to SARS in order to say, hey, I'm not paying my amount on time, which would normally mean that you'd be charged a 10% penalty and interest on the short payment. Instead of having the 10% penalty or interest, they're waiving those. If you submit an application to them saying, I can't pay and it's because of COVID-19. So that's something you definitely do want to look at if you are in a tough position and you can't. But once again, you're then losing out on all the other benefits. But it's one of those juggling exercises. You need to weigh up all your options and say, what's the best for my business going forward? There's not one size fits all. It's a dynamic exercise. And I think if you're unsure or struggling with this situation of what to do, we do have those one-on-one sessions where we can look at your business, look at kind of your challenges and say, hey, these are kind of the right options that we feel would help your business move forward. Simon's going to tackle the Department of Labor side. And so, yeah, thanks, Simon. Kick it off.
Thanks, Peter. Yeah, so just quickly through the Department of Labor, UIF is something that you register with the Department of Labor, and that's the Unemployment Insurance Fund. Predominantly, it's something that would be used if you lose your job as an employee or you go on maternity leave as an employee and you want to claim from the Unemployment Insurance Fund. It's something that comes off everyone's pay slip as an employee on a monthly basis, and the company also contributes towards it. And it's 1% of your salary, and it's capped at an amount just under 15,000, which is why you'll notice that the amount deductible from you never goes much more than 140 Rand a month, but obviously is limited to 1%. What's been really interesting over the last few months is that the Department of Labor has allowed people to claim through their TERS fund, which has paid out for people who are not unemployed, but are not earning a salary or have a reduced salary. So you will have noticed in the media recently that there was an amount of, I think, close to 15 billion Rand that was paid out to 3 million people in the month of April, which was the TERS payout to assist people through these times. So the TERS payout for May opened up last week, and a lot of companies will be claiming TERS for their staff. And that's for companies who just can't pay any salary, or companies who've been able to pay a portion of a salary, but not the full salary. So if that's something that you haven't looked into yet, I highly encourage you to go and look at that. UIF is something that on a monthly basis you are paying through your EMP 201 or your payroll return. So when someone pays the SARS return, you in fact are paying money for UIF, you're paying money for PAYE, which is going through SARS to government, and you're paying an amount of money for SDL, which is, like Peter mentioned, also going through to government for other areas. So most payroll systems that are well set up have the ability to send your U-filing report directly through them, but it's also important to understand how that all works. So we really encourage you to kind of understand how U-filing works, and much like your SARS return, your U-filing return gives information to various parties so they can understand what's happening. And this is important because what has happened is that a number of people were not doing the U-filing returns, and when they wanted to make a claim from the Department of Labor now during the COVID-19 period, they couldn't pick up certain employees, and those employees were not paid out any money because they were not sitting on the U-filing system. So just something important to kind of notice. The communication has been that the TERS payouts will continue for the month of May and June, but it is limited to the ability for the Department of Labor to have funds available. And the fact that they've paid out close to 15 billion already indicates that they will potentially have challenges in June. I'm confident that May they will pay out, but the fact that it came through so late means most people have not got paid anything for May. And there's going to be a lot of pressure on the Department of Labor to pay out now in the June period. So I really encourage you to ask about that and understand it. Again, if you don't have any understanding of what TERS is, or you need some assistance, please feel free to set up a session with us. We're happy to explain to you how it works and give you some guidance on how to do it. And it is a very well-structured process from the Department of Labor. They've built out a website. They've built out a lot of functionality on the go to try and help people. And it's something that we really encourage people to look at. And there is a Department of Labor application guide of how to use the TERS system. They just have changed the system and upgraded it a bit for the May period. But we really encourage you to look into this if you haven't done that already, or get your payroll provider or your accountant to look into it so you can benefit as much as possible for your staff. You'll see there's a URL, the uifecc.labor.gov.za COVID-19, and that's got a lot of information about TERS as well. So if there's any uncertainty, go take a look at that. I also do know they've made a special website that if you did not know what your UIF number was, because the UIF number with the Department of Labor is actually different to the one with SARS, you can go and put your PAYE number in on their website, and they'll give you your UIF number. So that's that section. Okay, we're going to move on to the next slide now. So COIDA, workman's compensation. Workman's compensation, everyone has to be registered for. This is not just for a risky company or something where you are dealing with building or machinery. Every company has to be registered, and every company is risk rated based on the industry they're in. So if you're an accountant sitting in an office, yes, there's a much lower risk of you getting injured on the job compared to someone who's a builder or someone who's working in a certain area that's a high risk business. But it doesn't mean that nothing can happen. You could still fall or injure yourself at the office. So based on that, they've got different rating profiles, and on an annual basis, you're required to do a return. And that return is normally required to be done by the end of May every year, and it's been pushed out now. So it is done later in this year, but the season has now been pushed out, I believe, to the end of June. So you would have this month to do the return. If you've done that return, you get a letter of good standing, which a lot of people ask for when you're applying for tenders or for projects or for payments. So it's something that's really important to know what your requirements are. Right now, your return would not be, or your letter of good standing from last year would no longer be valid. So please take a look at it. And I think it's very important to understand what that is. And effectively, it's an amount of money you're paying across to the Workmen's Compensation Fund. And that's how they manage payouts to people for various accidents and activities. And you're allowed to claim from that if you have someone who's injured in a workplace. So it's something that you pay into on an annual basis. You have the rights to claim against it, and you get a certificate for the fact that you paid it, and that can be used to show that you're up to date. So that's quite important. Then COVID-19 relief. They've got specific relief for people who've been diagnosed with COVID-19. And it's really important that if that does happen, you understand what your rights are in terms of what you can and can't claim. And we highly recommend you guys take a look at the Department of Labor's notice that has been issued around that, and understand it. So just understand that it's out there. So the first thing is you need to do your return by the end of this month. And depending on the size of your company and the value of your payroll, that will dictate the amount you've got to pay across to the Department of Labor for workman's comp. And then please note, if anyone in your office gets COVID-19, you have the ability to claim and get paid out as well. So I think that's kind of all I wanted to dwell on in terms of the Department of Labor section. And we'll go on to the next slide now. So CIPC, I briefly mentioned at the start. So I said a company is registered through the CIPC, and a company is effectively registered on an annual basis. You're required to pay an annual return, and that annual return effectively is to keep your status with the department, or with the CIPC active. So every year, almost on your birthday, as you can, if you want to call it, there's a requirement to submit a return. The return is relatively simple. It's not that complicated. You go onto their website, or your accountant or bookkeeper will go and do it, and you put in your annual turnover, and based on that, you will have to pay an amount of money. If you are late and you don't do it on time, there's a penalty for filing it late. And what also happens is if you ignore it for a period of time, they can start a process of deregistering your company, meaning your company is no longer valid. And what we've also found is that some organizations, when they are evaluating companies, will go onto CIPC and see if you're up to date with your returns. Because we've always found it's a good indicator if someone's on top of their admin, are they paying their annual returns? So if you're about to do business with someone and you log in and find out that they haven't done an annual return in 5 or 6 years, it does give you an indicator that they're not completely on top of their admin, which is not always a helpful sign if you're looking for someone who's organized and well structured. So that's just important to note. Any questions around that, please feel free to ask us. But it's one of those things, you have to do it every year. It's not optional. It's not your tax return. Some people get confused between their tax return and their annual return. They're two very different things. And the CIPC have started to ask extra questions when you do your return. Again, not very complicated, but they're more around who does your monthly accounting, who does your numbers, are you up to date, what are you doing? So those kind of questions, they're just trying to gather better information, and it's very important that you do this. And they've been mandated by the Companies Act to do this. So it's not an optional, you have to do it. So I think that's kind of all I want to touch on about CIPC. This is, I think, something that's kind of fundamentally important, and a lot of you probably know, but I'm just going to point it out really briefly. So you get fixed costs and you get variable costs, okay? A variable cost is a cost that changes depending on your usage. So if I had a prepaid cell phone, every phone call I make is going to cause an extra charge to be incurred for my telephone bill. Whereas if I had a all-you-can-use cell phone contract where every month I paid $9.99 irrespective of the number of phone calls I made, my charges would never go up. That's a pretty fixed kind of cost. It also talks to the fact that some costs are not variable in the short term. So if you've signed a certain contract, you might find you can't get out of it in a short bit of time. That number is locked in, and you've got no ability to move on from that number. Whereas in the longer term, you might have the ability to adjust it. So I think that's something that's quite important to understand. Cost of sales and operating costs. The cost of sale is something that's normally directly linked to the product you're selling or the service you're offering in order to do that. Whereas a operational cost is something that's incurred on a monthly basis as a cost in running your business. And then non-operational costs are costs that aren't linked to your month-to-month operations. So I think that's kind of the key things to understand there. Pete, you just want to just drive the slide on to the next one, please? So I'm just going to cover the scenario quickly, and then we're going to go to Q&A, guys, just to wrap up. So this is a scenario that we've dealt with in a couple of our clients, and I think it's really interesting to understand. I'm going to explain the scenario to you quickly, and then let's see what you guys would do as an answer, just as a practical way to understand this. So You log into your bank account, you've got 50,000 Rand left in the bank right now, and you've got 3 expenses that you need to pay. You've got rental, 35,000 Rand is owed to the landlord. Today is the 1st of June, they're expecting their rent for the month. Your staff salaries are due for May, 45,000 Rand needs to be paid. And you've got a key supplier who operates on a COD basis, meaning he wants money in his hands or her hands before they are going to deliver anything. And they want 50,000 Rand to be delivered. Now, I'm sure you can see that those 3 numbers are far too high to be paid for in full. You've got 3 options. Your first option says you pay your stock supplier in full and you get your stock. Second option says you pay your landlord in full and you pay your staff 15,000 Rand of their salaries or a third of their salaries. And your third option, you offer to pay 10,000 Rand to your landlord, 22,500 to your staff, and the balance you pay to your supplier. Okay, Peter, do you want to take over and close out?
Yeah, thanks, Si. Guys, I know time is vital to you guys, so we're going to actually take this concept of reviewing cost base into the next session, just to understand a little bit more about understanding your cost bases. What we essentially wanted to do is just bring it all together to say that as business owners, it's really important to understand your obligations. So you don't want to abdicate any responsibility for your business to somebody else. It's not that you're passing on responsibility to an accountant or an outsourced third-party professional that understands more about their topic than you. I understand that is important, and it's important to bring people that know more than you about certain topics. But at the end of the day, it's still your business. It's still important to make sure that you're the one making the final decisions based on the information provided and based on the understanding of a business as a whole. So the fact that you don't necessarily like numbers or they don't quite gel, you don't have to like them or let them gel. It's important for you to know enough about everything in your business to make the decisions to make your business go forward and thrive. So things like ETI and TERS. I've had a couple of brief conversations with guys saying, 1, they don't understand ETI. 2, they don't know how to apply for TERS. Now, both of those are massive benefits and savings to your business. It's really important to research those, ask questions of the people around you, your accountants, fellow business owners, to say, how do I get to grips with getting this information and benefiting from these things? So hold whomever is responsible for the various aspects of your business accountable for their function. It's still your responsibility to bring it all together, but you can still hold people accountable for it. Understand the relief available to you. There are a lot of relief mechanisms. We've touched on a few. There's a lot more out there that are from a cash flow perspective that we're going to try and delve into later. So it's really important for you to understand all the relief that is out there so you can make the best possible decision. And the concept of knowing your cost base and being proactive about managing your costs, I think we'll delve into a little bit on the second session, but it's essentially getting to grips with looking at that profit and loss. I know for some people it's scary, but looking at it and going, what does it mean? And if you don't know what a line means on that, ask somebody, because if you don't understand your own business's numbers, no one else is going to take responsibility for them. They're your numbers. And finally, get help. We work with about 150 small businesses around South Africa, and we're here to help you. And we're here to give you support, and the CDI are here to help you as well. So latch onto that support. Come prepared with questions that you want answered. Great. To kick it off, questions. It's time for you to ask anything else. I know we've got a couple. I'm going to bring up 1 or 2, and hopefully I can answer them relatively quickly.
I saw a couple of questions pop up, like what is TERS? Hopefully after hearing what we explained, you understood a little bit more that TERS is a fund that effectively the Department of Labor pays out to people who are getting either no salary, but they are still employed, or they're getting a reduced salary. So you have the ability to apply on behalf of your employees to get a top-up to their salary of naught or less than what they normally get. And the Department of Labor will pay that out to you as a company, or they'd pay it out to your employees directly and give them some additional funds to help them through the current times. So that really is a great option to do if you can. Yeah.
I know a couple of you have mentioned saying, I'm not sure how to do that, or where to find that. It is on the Department of Labor's website. In terms of the next one was, I know Kotso, you wanted to know around if your provisional tax is in December. So I'm assuming, and I'm making a big assumption that your second prov tax is in December. That you've got a year end of December, you'll have to pay up to 65% of the total tax due for that year by December, and then the remaining amounts will be due 6 months after that in your third provisional payment. So that would be halfway through next year that you'd have to pay the remaining 35%. It's definitely a deferral. It's not you only have to pay 65%. It's just a deferral of that payment. Said, what is the turnaround to paying claims? And can we do the claims retrospectively for April, which didn't happen due to the lockdown and lack of payments to employees? So I might be incorrect, but I think April is now closed for processing. They're still finishing up on a number of April claims, but they have opened up May now. So I don't think they're accepting new April claims. You would be able to, though, start applying for May. Yeah, it is unfortunate. It is a challenging process as well. So I'd love to tell you that the turnaround time is X, but unfortunately the Department of Labor has had quite an influx of people requesting, and they've never had that in their lives before. So they've had to upskill themselves, their systems, and get extra capacity. We have found that they've been a lot better in the last few weeks. So they're starting to pay people a lot quicker. There are still challenges around foreigners and people that don't necessarily have all their UIF stuff in order.
I think, Peter, the quickest I've seen a payout has been about 1 to 2 days, and that was towards the end of the first payout for April. So in late April, they were paying out within a few days, but that was people without any complications and everything was kind of correctly done. So I would expect the fact that they only opened up last week for May, that you might find that there's a bit of a backlog as they try and get on top of what's happening. But I think the secret here is get your information together, put your application in, and then you need to wait for them. So I think that's one of the key things here. And if you have foreign staff have started to get paid. So I see Joanna there said that she's got payouts for Zimbabwean staff, which is great. They have started paying foreign staff. It's just something you need to be patient of. And as much as Peter said, they have probably closed April, I would definitely try the best you can and see what happens. So if you haven't done anything yet, go to their website, go and apply, see if you can get it in. If they don't allow you to apply for April, then I think you've got your answer. But if they do allow you to apply, then potentially you've still got the opportunity to. But definitely get in for May either way around.
Yeah, fully agreed. And yeah, the foreign staff, I think, was a challenge to their system. But they are, as Jana said in the chat, they are starting to pay out. But it is a slightly different process than the normal application process. How do you handle your e-filing for UIF? Or do you do it through u-filing? I know I answered this, but I think it's valid because it's very confusing for a lot of people, and that's why we try to highlight that SARS is just an agent paying the Department of Labor the money that they collect, and What I mean by that is you haven't filed anything with the Department of Labor. You've just paid SARS, and they're on paying an amount. They don't know how much that amount relates to which people. So it's vital for you to either through your payroll system, if you've got one that can automatically file the UIF return, or you have to ask yourself or your accountants to go ahead and file it through the Department of Labor's website, like e-filing. And if you don't file those, then it's unable to take the amount you paid from SARS and apply it to your individual employees, which means you can't actually benefit from UIFs, payouts for maternity or for, when people are retrenched or the TERS process. So it is really important to understand that.
Peter, can I ask you a question?
Go ahead, Alan.
Sorry, what my question wasn't so much that, was what do you do with regard e-filing for UIF then? Do you just leave it 0? You put in a 0 require, because...
No. So when you're filing your, it's called the EMP 201, which is your monthly return. For UIF, you fill in the amounts from your payroll system or the calculated amount in your EMP 201, and SARS essentially pay that over to the Department of Labor. So that's their main mechanism for collecting money from employers. You don't just file it directly with the Department of Labor and pay the Department of Labor through e-filing. You always pay through SARS when you're dealing with the company.
So what you're saying is I do the EMP 201 like normal, fill them all in and pay through SARS, then go on to e-filing and then give them the breakdown. But don't make 100%. The payment through e-filing.
Correct.
Yeah.
Because e-filing is asking for a payment as well.
E-filing has the ability to pay. So a lot of people, if they have domestic workers, for example, will pay through e-filing because they don't have a SARS account. So there is definitely a separation. Some of the payroll programs that exist actually can do the return to e-filing directly for you. So you don't have to log into that. So it's definitely worthwhile looking at the different options out there. So for example, the payroll program we use allows you to push the data directly to e-filing rather than you having to log in there and do it yourself.
All right. Can I just ask one last question? Your payroll system, does that allow for companies to have staff that are on piecemeal, where they get paid a different amount every week?
Yes.
Yep.
Great. Thanks.
Not a problem, Alan. Thanks a lot.
I just want to say thank you very much, Simon and Peter, for the information. I think there was a lot of information to deal with. But I think what's going to be very important is Wednesday's webinar, where we can tie in all of this back to budgeting and cash flow and show people where the benefits are practically in their business. And I think there's a couple of relief mechanisms that we haven't touched on yet that we will touch on in Wednesday's session. I think it's a really practical session on Wednesday and really helps tie everything together. So I do hope everybody joins and finds benefit in watching this all come together in managing your cash flow and in managing your budgets. I'd just like to thank the sponsors again for this session, which is the City of Cape Town, Invest Cape Town, and UNESCO. So thanks very much to everybody for joining. I know you've got a lot going on. I really do appreciate it. Keep well and have a good day.
Thanks a lot, guys.
Cheers.
Thanks, guys. Bye-bye.